Welcome to the Estates Made Simple podcast with Jenna Carvello and Gordon Vanderleek. We are on a mission to simplify the world of estate administration, helping executors gain the knowledge required to manage an estate. Please note, the following is for informational purposes only and is not to be considered legal, tax, or financial advice. We recommend you seek individualized advice for your unique situation with qualified professionals.
Well, hello, Gord. Nice to see you again, as always.
Hi, Jenna.
We have a very special guest today, Matt Sharp from Structure LLP. Matt, how are you doing?
Very well, and great to be here. Nice to meet with you, Jenna. Nice to meet with you, Gord.
Well, thanks for coming on. And as Gordon likes to say it, thanks for nerding out with us on estate planning and estate execution matters. Today, we really wanted to dive a little bit deeper into tax returns, specifically what tax returns are, required at death, and just get the advice and opinions from a specialist. I know your firm specializes in estate returns, as well as you have extensive experience in cross-border issues. So you're the man for the job. We'd love to hear your thoughts and maybe some stories along the way, and you can provide some guidance for our listeners who are dealing with these types of matters when administering an estate.
Well, that's absolutely great, and I'm happy to do that. So, if you're looking to nerd out on any issue, getting a CPA in the room is usually a good start.
Perfect. Well, we thought we'd start with a tough question for you, Matt. First question for our listeners is really, what tax returns are required at death, and any tips and traps that you have for estate executors when dealing with death returns.
Absolutely. And my first advice, as always, would be if you are acting as an executor for an estate of a loved one or a friend, would be to listen to previous episodes of this podcast. My business partner has said a number of times that he's going to send this to any one of his clients acting, just as there's such a wealth of information there. And we often like to see tax as being secondary in estate administration, but of course it creates such a financial burden to those who are, whether it's the residuary beneficiaries or the legacies. Tax really does drive how we file these things, how we finalize these things, and the comfort the executors can gain over this, as Canada Revenue Agency could come after executors if things aren't filed correctly or if certain steps aren't taken. At a very basic level, the first thing that's required for any individual upon their passing is a terminal tax return. This tax return covers the period from January 1st of the given year right up to the moment before someone's passing. And ordinarily, this is a relatively straightforward return with a twist. It still has the same employment income slips you'd have, investment income slips you'd have, but there's also an additional twist to it where any capital property you owned immediately prior to your death is deemed to have been sold at its fair market value. To give an example of this, because the concept isn't always straightforward, if you had a portfolio of securities with a bank, you would be immediately deemed to have sold those on the open market. So if you had TD Bank stock, for instance, that you bought for $100 and was now worth $200, you'd have a capital gain to report of $100 on which you have to pay tax. Now, this seems very straightforward, but actually calculating these balances and finding the history with more complex assets can take quite some time. These are among the most complicated returns we have, and that's really one of the more easy examples of it. And there's a lot of strategy that ties into this, as well as there's a lot of post-mortem tools you can do after the fact to manage this.
And so after your terminal return, just as you mentioned, a lot of history and research goes into that. Something that I think about in my role as a previous executor is trying to find the cost base of these securities that individuals held. Because if you don't have proper records, you don't necessarily know what it was purchased for. And that can be a nightmare in and of itself. So I can appreciate how complex it does get just with that specific item. And terminal returns, would you say, have, a large significant balance owing for CRA? And what types of issues do executors face when having to pay that bill?
One of the largest issues we run into, and one that really affects a lot of Canadians, is RRSPs and registered retirement income funds. These are also deemed disposed at the point of death. They do not have a cost base. Whatever their value is immediately brought into income. And often as an estate planning measure, these have beneficiaries set up on them. So it will skip the estate and get outside of that, but that does not exempt people from the tax. So if you have $1 million RRSP balance, you have $1 million worth of full rate income, which can be taxed as high as 48% in Alberta or 54% in Nova Scotia. Now, if that's not an estate asset, that means the estate really needs to find something else to pay that tax liability. liability. Now, these are very common across most Canadian tax returns. We'll see this. If Canadians are older, typically these balances can get lower, but if they've been well invested, this can become a really significant problem at the point of passing. I would consider this to be probably something we have a lot of trouble planning around, because the only way to really plan around this is to draw it down faster and incur that tax liability more quickly. But I would encourage everyone who is considering acting as an executor to have a discussion with the testator before they're passing about, what do you hold? How have you decided to attend to this RRSP or RIF balance? And is it going to go to the estate? And if it's not going to go to the estate, if you've decided to make it skip the estate for probate purposes or simplicity purposes, how are you going to pay that resultant tax liability without having to claw it back from other people?
Yeah, what you're saying is, and I've seen this in estate situations, it can create an immediate liquidity problem, right? You can imagine that if, let's say, the major assets are your RSP and real estate, like your home, or other real estate investments. You have, in your example, $1 million coming in. That's, let's call it, close to $500,000 of tax, $480,000 in if there isn't cash reserves to pay that, and there isn't life insurance proceeds, where's that money going to come from? CRAs, in my experience, not typically going to say, well, okay, just pay it when you can. And we understand that there may be take you time to sell the real estate. No, it's like, maybe I got to go get a mortgage on the real estate in order to, because I got a deadline. The accountant is telling me I need a check payable to the receiver general for $480,000. Where in the world is that going to come from? So I appreciate your comments, because I guess my response or commentary to that, and maybe that elicits a further response, would be, if there's a beneficiary designation where it goes outside of the estate, you have to think through, well, who's paying the tax on that, right? And it's particularly troublesome as if the beneficiary designation in the RSP is different than the beneficiaries of the residue of the estate. You only have to think of a blended family situation to say, well, adult children get the house and the surviving second wife or husband gets the RSP. Well, now there's an immediate fight about, well, who has to pay the tax liability on that? So I appreciate you bringing that to our audience's attention, because, as you say, with the numbers that are involved, it could create, in the absence of proper planning, can create, that tension in the family about what's going to happen here.
And I'm going to caveat that as well. If your RRSP or those properties do go to your spouse, typically there's relief in the form of spousal rollovers. But it does become an issue if you pass down property to your child. But I do have a tip there that we've really been pushing our clients for people who do have large real estate balances or large investment balances that will become liquidated prior to their passing. If somebody gets sick, or even before, talking with somebody along the lines of a private banker at their particular bank to have these facilities ready really does help to alleviate the stress. If somebody passes away, you might have as much as 6 months or more to pay the taxes, but it can take a very long time to get the appropriate liquidity. And this helps out in some of the post-mortem planning as well. But getting your financial affairs in order is a qualitative, not quantitative way to actually pay these tax liabilities, as the bank will have your profile, they'll know what to do, and they'll know how to reach out to you. So you're not having to pay what is now 10% interest on what can be a very large tax liability. Yeah,
it could be a serious problem. Yeah,
and there is relief that can be had on that if there are qualitative issues. Recently, I had an estate that did have a lot of real estate that had to be, or that resulted in a large tax liability, and we were able to file a claim with Fairness at Canada Revenue Agency, and they did relieve almost $70,000 in interest on this. So, but you really do have to be ready to make that application, as if it fails, or if it takes too long to get, that balance just keeps getting larger and larger and larger.
So we talked a little bit about that terminal return, and I think, for the reasons you've articulated, I think that's usually the one where there's a lot of tax liability because of this deemed disposition on death, right? And then take us through, I guess, going forward from the moment, because you talked about from January 1st to the date of death, we have this terminal return, and then from the date of death onward, there's also an obligation on the part of the executor to file tax returns with the Canada Revenue Agency. You're not done with the terminal return. So take us through that. And I know there's the concept of a graduated rate estate. So maybe the returns that are filed after the date of death, and what does the Income Tax Act say about all that would be helpful for executors to know about?
I'm glad you asked that question, Gordon. The graduated rate estate is another return that comes after somebody's date of passing. So assuming that someone died on June 30th of a given year, there would be another return that covers the period July 1st up until the estate is wound up. Now, this estate return will have a mandatory filing within 365 days of the date of the deceased, but that can be any date. So you could go from June or July 1st to June 30th of the next year. And we often recommend that as it gives the flexibility to look at what the estate has. And if you give it a December year end, you're generally going to be rushed on this. Often we can get these things done in 1 year. And there is a trick that ties into the deemed disposition as well. The estate is deemed to purchase all the property of the deceased at its fair market value at that point. If there's a market fluctuation like we saw in 2022, and the assets are subsequently sold at a loss within the first year, we can carry that loss back and recover some of that tax that's been paid. And that's just one trick. Graduated rate estates do get the same tax rates at graduated rates, hence the name, as an individual. So you have time to figure out how you're going to deal with the estate, how you're going to administer it, how you're going to help out the residuary beneficiaries and legatees without incurring a tremendous amount of tax generally. Of course, if the estate has a lot in it, a lot of that income will be at the highest rate and it's not a lot of benefit, but you have a lot of flexibility with that off calendar year end.
No, that's helpful. What are I guess practically, if you, in your example, if you date of death is June 30th, and so you're doing this graduated rate estate, and it, say for a full 365 days, what would be the date on which you have to file that return, that T3 return for that first year of that graduated rate estate?
It's due within 90 days of its fiscal period. So if you choose that June 30th year end, it's due generally by September 30th following.
And while we're on the topic of deadlines, and obviously for our audience, if you're an executor, this, as you begin to gather this, it's important to get a professional to make sure in your particular case with the planning and also the facts of each estate, to make sure you get advice right up front of what those deadlines are, and you don't want to miss those. But for that terminal return, what are the rules relating to when that terminal return has to be filed? Just going backwards a little bit on the same topic.
Absolutely. So if you died within the first 10 months of the year, between January 1st and October 31st, you have the exact same April 31st or April 30th filing deadline. If you died in November or December, it's due within 6 months of the date of death. So you have a little bit of an extension there, but not too much of one. Now there is, I have one this year where someone died on November 4th. So I only get a 4-day extension on this. So in limited circumstances, it cannot be that beneficial, but it does give a little bit of a break there because it does take a lot of time to put together all this information, especially if it's a family member who needs to take time to grieve in any case, who's acting as executor.
Yeah. And also the fact of gathering for all these returns, maybe even particularly for the terminal return, you have to gather all the information, right? And say, well, I think most people will go, I have no idea what are all the things that I need, what are all the slips I need and who do I ask for? I think we all sort of figure out our own tax returns and we kind of know what to expect and what to put in place, but you have to figure all that out in a situation where you may not have the same level of knowledge, right? And gather that for the accountant in terms of that.
Yeah, and from a practical perspective, it's a good idea to engage an accountant almost as soon as the person has passed away. Once you've been through the preliminary grieving period, it's good to reach out, as it can be hard enough nowadays to find an accountant, but finding one in March and April taking on work at this time is almost impossible. So it is a good idea to organize these early, as it gives a lot of time to put the assets together and you can understand what the tax liability might be. So you can coordinate to hold back enough assets early on in whatever form makes sense to understand that the tax liability will be due not that far in the future. The estates we've been dealing with over the last year, we've really been pushing to get the tax liability ascertained in the autumn, so it doesn't come as a surprise in Q1. Winter is cold enough without finding out that you have to pay several $100,000 in April.
Yeah.
Or that you're responsible for coming up with it.
Well, and we know we're recording this during your tax season, so we appreciate your time here and willingness to step away from those important tax matters with a looming deadline ahead of you. But switching gears a little bit, some of the estates that Gordon and I have been involved in the past, and as well as many Canadian-based estates, have some U.S. considerations with respect to possible tax filings at death. So can you just highlight some possible situations that an executor needs to be aware of if there may be a U.S. filing requirement for the deceased?
Absolutely. So there's one that catches a lot of people by surprise, but it does have a very significant IRS penalty. If you hold more than $60,000 USD worth of US situs property, there's a filing, even though it usually doesn't result in any tax. So there is the quantum of the penalty is subject to change, but it was significant the last time I took a look through it. So I believe it was on the order of around 10,000 US dollars, though please don't quote me on that. This definition of US situs property does not apply to just real estate. If you hold greater than $60,000 worth of Apple or Nvidia shares or any ETFs or stocks listed on a US exchange, you are captured under this particular provision of the IRS code. So it's always a good idea to engage again with an accountant early to get this filing set up, as US CPAs are even harder to find than Canadian CPAs. I've worked very closely over the last little while with US CPAs on these matters, but I would say within 2 months at the date of death, you should really start looking at what the portfolio the deceased held to make sure that this doesn't apply. Now, also, this does not usually apply to registered accounts, but it's always worth talking with a US CPA about this. And that's the simpler of the two taxes. Occasionally, if you run into a very large estate, you can be subject to the US estate tax on US situs property, which includes those stocks, it includes real estate, anything that the US has claim over. So this is an up to 40% tax on the fair market value of properties. There's an exemption to that is fairly high, but it's going to change in the next couple of years here unless Congress makes a change to that. But it is something to get ahead of, and it's something to plan for. There are also circumstances in which common Canadian estate planning issues can get in the way of this or cause the problem to be worse, one of which is if somebody puts assets into a joint partner trust. We had a situation recently where somebody entered into some excellent probate planning, but gave their lawyer a very limited mandate. And as a result of that, there was a $5 million USD estate tax assessed on it. But they were able to save $70,000 in probate fees. So there was some comfort there.
I think that garners that statement of the tax tail wagged the dog on that one, right?
Yep. So it's always,
I guess it'd be the probate was the tail that wagged the dog. It overshadowed the broader picture of planning, and yeah.
It speaks to the philosophy of planning when it comes to estate matters, particularly in tax, but with everything. It's a comprehensive team-based approach that's really going to give the best outcome for executors. So if you're engaging early and often with your Canadian CPA, your US CPA, your lawyer, your financial people, your trust company, if it comes down to it, having that high level of communication early on really does give better outcomes. And pre-mortem is always better, but post-mortem, a high level of communication really helps.
The other area of complexity that I see that I want you to comment on, we talked about the U.S. assets and some definite planning opportunity there, avoiding some of those bad results, right, as you spoke of, would be if the deceased owns shares in a private company. I think it's fair to say Alberta in general, and certainly Calgary, an area where we live, you could argue a very entrepreneurial town. There's lots of people that have done their pursued their dream and have a startup. I guess Jenna, you and I are owners of shares in companies, right? As starting our businesses, and that's not atypical. So if you're the executor and learn that, okay, this person ran a small business, what are some of the considerations? What are the checklist of things that you're going through to talk to that executor about the issues that need to be dealt with and some of the issues to identify there?
Well, the principal one goes back to that deemed disposition. There's a deemed sale of private company shares as well. If somebody has bootstrapped the company from day one, if they started it up, usually the shares have a notional value or a small value compared to their fair market value. So the capital gain on this can be extraordinary. A very common structure is to hold investments from surplus profits in a holding company. And these often have values that are worth the millions, whereas the cost base will be in the tens of dollars or less. So we end up with just a huge capital gain and an immediate need for liquidity to pay the taxes. Now, if you dissolve the company or take money out of it, that's deemed to be a dividend for tax purposes. So you end up in a situation where you're paying capital gains tax and dividend tax on the same assets coming out to the estate. Now, there's a couple of curative measures that go along with this, one of which is a loss carryback plan where you can wind up the company, take everything as a dividend within the first year. And a lot of that capital gains tax is refunded. And the other is you can use the capital gains rate to extract money from the company. Both of these plans are extraordinarily complicated and require planning in advance. And in the wind up plan, you have a very short time in which to do it. If you are acting as an executor, you accept the appointment, or if you're talking with the person you're planning to act as personal representative or executor for, I would recommend getting a comprehensive understanding early on of what they hold, as it's good to have a contingency plan ready for this, as there's all types of things to look at in advance and just to plan for it. We can't always understand when somebody's going to pass away, but at least we can know what to do as soon as they do. Now, most accountants and most lawyers are willing to act or to move on a dime when it comes to getting these plans together. But the first plan, the wind-up plan, does have that hard deadline that you have to meet. And the second one, extracting at capital gains rates, you have to do that in a phased manner over years, or else you can end up with double or triple taxation. So it is something that can put a lot of stress on executors if they don't know what to get into. But that's the point at which you'd want to speak to an experienced estate accountant, experienced estate lawyer, experienced tax accountant, experienced tax lawyer, or all of the above in making sure that you're coming up with a plan. And depending on how the will is drafted, one of these plans might work better than the other, and the tax tail shouldn't wag the dog again. Yeah. If you have elder beneficiaries within an estate who will lose their inheritance if they pass away, the second plan using the capital gains rates, which we call pipeline, may not be the right solution if they're not going to be around in 5 years. You certainly don't want to disclaim anybody from their inheritance just to get the tax efficiencies out of it.
Yeah, I mean, that could really elongate an estate administration period. So for an executor to be involved in that type of planning, that's a big job, especially, when you're dealing with these private company shares over several years, as you mentioned. And so I know you touched on a lot of these items throughout the discussion, but in terms of individuals planning for their own estate, what comments or suggestions would you have before finalizing their documents or their affairs?
A couple of things I would consider, simply because estates can be such an emotional matter. The first of which is one I've really been recommending for my clients as of late, which is to look at agency options, to have somebody who can act for you right away. Many of the trust companies offer agency where they won't be appointed as a personal representative, but they will do the services for you. So you're still signing, you're still doing the honorary task of the deceased, but it takes away a lot of the administrative burden, and perhaps somebody can act more quickly. Now, that's not for everyone, though. There is a cost associated with that. I will tell all my clients I think it's worth it, but it is something some people actually do want to be actively involved within the estate and do everything just to honor their relative or friend's memory. The other option is talk early and often with the financial advisor, accountant, and lawyer. All these pre-mortem and post-mortem plans just take so much effort and energy after the deceased has passed away. It's good to have an understanding of what they've got early on, and look at the other more exotic alternatives as well. If you know you're going to be taking over someone's estate, find out who their insurance company is, find out how quickly they're going to be notified of the payout. Look at the options. If somebody's going to leave you with issues, look at exactly what they've got. Ask if they've done their own estate planning. Read very carefully the will that you're signing off on to be a personal representative on. As you should look at things like, if somebody has left $1 million worth of payments to people, make sure that their only asset isn't real estate, as that's very hard to bring up the appropriate liquidity to pay people out immediately. It's just the whole universe of factors. But again, I go back to talk to their advisors and yours to find out the full picture of what they've got.
I would also add to add your contact information in their death files.
Yes.
Well, but on that point, and it's interesting, it just came from a meeting where we were having that conversation. They had a sort of a memo to the kids, right, dealing with the parents. And one of the things we said should be in there is, well, here's your team of advisors, right? So I think making it easier when as part of the estate and you've got the right people in place would be maybe making sure your executor has a list of people to turn to, because it might be a bit of a daunting task to try to assemble that team. So if you can present the executor with, well, here's the people I have trust in, and they know everything about me, and you can seamlessly work with them. They have my files, they know my wishes, we've done the planning, can be highly valuable. But I think those are good questions to ask. We had a previous episode, right, Jenna, about, well, what questions you should should ask if you've been asked to be an executor, and this would be one of them, right? Saying, okay, well, tell me a little bit about the assets. Is everything in there, right? If you say, oh, sure, assuming the person has some wealth and it turns out it's an insolvent estate, that might affect your decision about whether you're going to say yes or not. So those are very good points. The other one, just having that communication, what that will really help with is the issue of making sure that there isn't any deadlines missed. I appreciate and maybe reemphasize what you said earlier, which is there are some deadlines and fairly quick timeframes. I presume there's probably some elections or something. Okay, by December 31st, you have to do this. So if somebody passes away on, earlier we were talking about an example of November 4th. Well, you don't have that much time. And then there's Christmas in there. If something has to be filed by December 31. So that's information you need to know right away. Knowing you have your team ready to go, you can jump in and you know who those people are versus you're Googling, best accountant in Calgary. Of course, Matt's name would come up. But I mean, assuming you had to go through those efforts and you're interviewing a few to get price quotes and you want to, okay, who am I going to work with? That all takes time. Maybe you missed that election deadline, right? Which might have some consequence to the beneficiaries of the estate. It's not a great way to start the administration. So I think those are really, that's really sage advice.
That is, and you run into practical realities just even going back on that. And I've seen this time after time. I mean, certain institutions aren't able to move or to turn on a dime with certain things. If you have to get your stocks sold by December 31st in order to get that loss to carry back. And I have had 2 estates in my career where people actually did pass away on December 31st, which was very helpful from a reporting perspective. But if you try and contact an investment advisor on December 19th to sell off those stocks, well, the TSX is closed through a bunch of that. Everybody's gone. So getting these things organized can be very difficult. But if you have a plan coming into it and you work with the team of advisors coming into it, you can ordinarily circumvent that and make the whole process, at least from a tax perspective, a lot more straightforward.
I think the other point as we close out would also be to say the greater the complexity of your situation, the assets that you hold, your family dynamics, the more, I guess, we would advise do the planning ahead. Right. I think it's sort of proportionate. If you have the US assets, if you have company shares, you don't want to sort of just not do the planning on that because there's a level of complexity. So that's usually a good thing. You've amassed wealth and you have this, but it just means you've got to there's more issues to deal with ahead of time to reduce the burden on the executors. So I think those are some good lessons. Matt, we'll maybe give a moment for you just to provide your contact information and where people can get a hold of you if they have more questions with regard to this. And in that, thank you very much, as Jenna said, taking time out of sort of a ludicrous part of your where you've got so many demands, and CRA is not making your life any easier by making all this area more complex and giving tight deadlines. So we're truly appreciative of the good advice you've given. I think this has been a great talk together. But share a bit just on this recording where people can get a hold of you.
Certainly, I can always be reached at 403-930-6760, which is my business line, or matt@structurecpa.com. If I happen to not be there, 403-475-8033 is my front desk. So.
Excellent. Thank you for that information. We'll include some references in the show notes and in our postings. So thank you very much for that and wish you well.
Well, that's appreciated. And thank you again for the opportunity to be here.